Ever been on a bungee jump? Or perhaps tried a skydive? It's built into us to be afraid of heights. It's a natural defense mechanism to protect us from a deadly fall. However, these natural defenses are a danger to our investment decision-making processes. Let's debunk a few myths and reframe our mindset for better investment choices. Welcome to another episode of Money Matters. Often, I hear that when markets are on a strong rally, investors reach out to me and ask, markets are breaking an all-time high. Is it ready for a crash? Or, this stock is looking expensive. Should I sell now? These observations are clearly based on where the price stands relative to the past price. In essence, the investors are sensing a fear of heights and feels in danger of a fall. Let's tackle the first comment. Markets, in the long term at least, naturally continue on an upwards trend, riding out the short-term fluctuations. They are quite often at an all-time high. Markets rise because companies rise in value, companies rise in value because their earnings rise, and earnings rise because sales rise from increasing levels of consumption. In short, we spend money, companies make money, markets rise. This overall upwards trend is due to the 3 Ps. 1. The world population is increasing, and with that comes consumption. 2. Productivity increases due to innovations and advancements. We can produce goods better and produce them faster. Goods exist today that never existed in the past. 3. Personal inflation means it is human nature to want to upgrade our standard of living. We are willing to spend more to enjoy a better lifestyle, or perhaps to keep up with others. For many, instant coffee is no longer enough. We want single origin beans, brewed by the pour-over method, and we're willing to pay the premium for it. Just look at your own lifestyle. What upgrades have you made to your life as you've progressed through the years? It's easy to go back to, let's say, the S&P 500 index and take a long-term perspective back over the past 40 years. Your $1 million invested 40 years ago would be worth roughly $36.9 million today. Of course, with a few big bumps along the way. It's not easy when looking forwards, not over the short term at least. What are my predictions for this year? Your guess is as good as mine. How about my predictions over the next 40 years? Well, my crystal ball says it will be up and up big, short of a meteor strike hitting the planet. Secondly, investors like to look at individual stock prices, again, looking backwards to try to guess the future price. They also look at the metrics like price to earnings ratio, but again, looking backwards to see if it's expensive. Someone once said, over-reliance on the rearview mirror is not a good way to drive, nor is it good to manage risk. On the other hand, ignoring what we see in the rearview mirror is neither prudent nor wise. We need to put things into context. Investors forget that there are 2 elements to the price-earnings ratio. Price relative to earnings. There is no empirical evidence to show that PE alone is any reliable indicator of whether a stock is expensive or not, and certainly not whether it's going to rise or fall. It's also a question of framing. If an individual stands on top of the International Commerce Centre in Hong Kong on the 118th floor and look over the edge, they would naturally fear the huge drop. But if the individual stands on top of the bar on the 118th floor and jumps down onto the floor, that would be relatively fine. They are still on the 118th floor, but there's really no way for them to fall onto the ground floor 484 meters below. Whilst it's certainly a chance that any one company can become worthless tomorrow, a broad-based index like that of the S&P 500 is diversified and unlikely or impossible for it to become worthless tomorrow. But investors' natural fear of heights will reframe and exaggerate the real potential loss. Don't get me wrong, markets can easily fall double digits at a mere whiff of any uncertainty, and partially due to the herding effect. But that very same herding effect can lead investors to exit the market exactly at the wrong time, when fear is at its highest and prices are at their lowest. Let's take a look at some data. PEs were very high at the end of 2008. The S&P 500 PE was around 60.7 based on a 12 months trailing earnings at the end of 2008. Way above average, but if you thought high PEs were risky, you would have avoided stocks and missed the big 27% surge in US stocks and 30% in world stocks in 2009. The PE was high then because earnings were hugely and temporarily depressed because of the recession. Very low relative to the price, giving a very high PE. And here's the kicker. The year-end 2008 PEs were also way above where the year-end 2007 PEs were, where the market peaked and what followed was the recession and earnings started to decline. So, if during this time you were relying on PEs to tell you when to sell, you would have lost and lost big. Another example, the S&P 500 PE was 31.9 at the end of 2002. Again, very high, but also a great time to own stocks. US and world stocks returned 29% and 33% respectively. Again, PEs were high then because earnings had crashed during a recession. It's common to see high PEs during and after recessions, usually a fantastic time to own stocks. In both these examples, the PE was reflecting the present and the trailing 12 months past, not looking forward to where earnings are going. But stocks look forward and typically move ahead of the earnings. They fall before earnings do and go up before earnings rise. PE in isolation is not a reliable indicator of where markets will go. It's an incomplete snapshot in time. Confirmation bias will condition those to disagree with this. They will find the evidence that supports their theory, but ignore all the evidence that doesn't and destroys their theory. It's another way for investors to look for simple patterns, when we know that markets are not simple like that. There is never a silver bullet to investing. You can slice and dice it any way you want, but the fact remains that markets and skyscrapers will continue to reach new heights. Human progression ultimately powers the markets through challenges such as climate change, global pandemics, riots and wars, and any number of black swan events. Innovation and perseverance will see the human race through these bumps in the road. Only a global apocalyptic event will see an end to world markets. But by that point, any investment asset you own will be worthless, and only basic living assets will be of any value. Think food and water. But I digress. So, get on the ride, remain steadfast along the ups and downs, and don't be afraid of heights. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.